Hello everyone, welcome to Macroeconomics. Today's subject is monetary policy and economic activity. Monetary policy is one of the most important economic tools that is used to stimulate or contract economic activity, and it creates transmission channels that can go through the economy to stimulate the market. The money market creates a transmission mechanism, which is the routes or channels that travel through the economy and create ripple effects within the market to stimulate the economy. When it comes to the goods and services that are consumed or produced by consumers and producers. The goods and services market is represented by the aggregate demand by consumers and all the collective members in the economy and aggregate supply, or essentially the ADAS economic framework. The demand for money is demanded by all of the economic agents and participants that demand money. Essentially, is the quantity demanded for money at any given interest rate. And it is represented by the inverse relationship between the quantity demanded of money and the price of holding money, which in this case is the level of interest rates. So we're going to have the interest rate market, the money supply market, and the aggregate demand and aggregate supply model to show how the economy can be stimulated and how the transmission mechanisms occur within monetary policy. If we take a look at model A, it represents the interest rates on the vertical axis, the quantity of money on the horizontal axis, and the demand for money curve, which is represented by the red downward sloping line. The demand for money tends to be downward sloping. Essentially, if the interest rates are relatively high, the quantity of money, M2, demanded, is lower, and if the interest rates drops, if it decreases, the quantity of money demanded increases, so it's a little bit higher. So we have an inverse relationship. The higher the interest rate, the lower the quantity demanded for money. The lower the interest rates, the greater the quantity demanded for money, and vice versa. Model B represents the money supply curve as a vertical line, which is controlled by the Federal Reserve and other economic conditions. The line represents the quantity of money that is largely controlled by the Fed, but not exclusively controlled by the Fed. There's other economic factors that affect the money supply, and also the interest rate on the vertical axis, the quantity of money. We're going to use the money supply line and bring it in the interest rate market to determine the equilibrium rate for economic activity. So essentially, we have the demand for money and interest rates, the supply of money and interest rates. Bring them together, we're going to have an equilibrium rate in which the market will clear. The money market can be viewed in different ways. We're going to look at the Keynesian view of monetary policy, which became to be known as the Keynesian transmission mechanism. And the Keynesian transmission mechanism is one of the most commonly used and most commonly followed, although there's views that contradict or argue against it. It basically states that the supply of money within the economic model shows the supply of money as a vertical line that is controlled by and determined by the Federal Reserve. The reason the money supply is not exclusively controlled primarily by the Fed is because both banks and public policy also play a major role in determining the money supply process, but is determined primarily and has significant control in the Federal Reserve structure. The equilibrium in the money market is going to be where the quantity demanded for money curve intersects the quantity supply of money or the money supply curve by the Fed. So here we have the model that indicates a money market in equilibrium. This is referred to as the money market. The equilibrium in the money market occurs where the money supply, represented by S1, money supply 1, here we have money supply 1, intersects the demand for money by the market at a particular interest rate. So the equilibrium interest rate occurs specifically at interest rate 1, where the money supply intersects the demand for money. This is the money market interest rate equilibrium, where the demand for money is fulfilled by the supply of money at a set interest rate. Now this interest rate could be targeted by the Fed in order to stimulate economic activity differently by changing the money supply. If we look at interest rate number 2, which is greater than the equilibrium rate, at this interest rate, what we're going to have is we're going to have less quantity demanded by the demanders of money and a greater money supply. So we're going to have a surplus of funds at a higher rate, or in this case, an excess supply of money. So the interest rate is pushed down to the equilibrium rate. If the interest rate is too low, at a lower interest rate, we have higher quantity demanded for money, and the money supply in this case is fixed at M1. We may have higher quantity demanded than the money supply available, and we have an excess demand for money at a lower rate. So what we have here is the interest rate is pushed back to equilibrium, and the market clears at an equilibrium interest rate. Now, how would the interest rate change? It's essentially changing when the money supply can change, or when the money supply changes. And that is controlled primarily by the Federal Reserve and other public policy and bank forces. Now, with the Keynesian transmission mechanism, essentially shows the route between the money market and how it travels to the goods and services market, or in this case, the aggregate demand, aggregate supply model. So we're going to have the money market, which shows the money supply and the interest rates, how it creates investment or consumption, and how it stimulates aggregate demand, which essentially is represented by the following condition. When the money supply increases or when it decreases, the Keynesian transmission mechanism works in a particular step-by-step process. If the money supply increases, number one, we're going to increase the money supply curve, and the interest rate is going to be lower with more money available. There's lower rates, interest rates drop, and we have the possibility of higher investment at lower rates or higher consumption at lower rates. And since investment and consumption are part of aggregate demand, if investment increases or consumption increases, aggregate demand increases. When aggregate demand increases, the economic GDP or level of output increases, and economic activity increases, assuming prices are fixed in the short term or sticky. If the money supply declines, transmission number two, if the money supply declines, we're going to have higher interest rates. With higher interest rates, we have less ability to invest or less ability to consume, vice versa, both of them together. And with lower interest rates, aggregate demand declines and gross domestic output declines, and prices are considered sticky. One of them is considered expansionary, the other one is considered contractionary. If aggregate demand increases, it expands economic activity. If aggregate demand contracts, it contracts economic activity. When we're looking at the Keynesian transmission mechanism, it's what the most widely used, and other views contradict or argue against it. Here we have the model illustrating transmission channel number one. Here, transmission channel one, with the money supply increases. Here we have model number A, the Keynesian transmission mechanism. It shows the increase in the money supply, with S1 being money supply 1, shifting to the right, with an increase in the money supply shifting right. We have a higher money supply controlled by the Fed. An increase in the money supply brings the interest rate equilibrium down from I1 to I2. Lower interest rates lead to a greater ability to invest. And we have the investment demand curve. The investment demand curve represented by the yellow line. At lower interest rates from I1 to I2, the investment that is generated increases. With higher investment, we go to transmission number 3. Aggregate demand is equal to consumption, investment, government spending, and net exports. Investment increases, and that pushes aggregate demand from the red solid curve to the right, to AD2. Aggregate demand increases, and if you look at the level of real GDP, gross domestic product will increase as well. Quantity of output or gross output increases from AD1 to AD2, and the economy expands. It's important to note here that the price is considered to be fixed. The price level is fixed or sticky in the short term. If we're operating in this particular point between A and B, prices are fixed, output increases, and we have a perfectly transmission mechanism that stimulates economic activity. An increase in the money supply leads to lower interest rates in the market. With lower interest rates, investors can invest from I1 to I2. With more investment, there's a greater increase in gross domestic output. since investment generates productivity and output. From Q1 to Q2, aggregate demand AD1 shifts to AD2, and we have point A move to point B with a new AD demand curve shifting, and prices are fixed. It's a very smooth transition, and the economy expands. Now, if the economy were to contract, it will move in the opposite direction. The Keynesian mechanism, it is perceived that it can often be blocked. It can be smaller than what it looked like, or it can be not be effective, and so on. The Keynesian transmission channel is indirect because it has to go through certain steps in order to influence economic activity. Sometimes with lower interest rates, investors may not invest. It depends. It's possible. So that's a different view of how money supply may not always work. But for the most part, it does. The change in the money market, it may not directly affect the goods and services market because it first has to go through the investors and then to the market. So what we see here, real GDP may or may not increase significantly because the investors in the goods and services market stands right in between, and possibly at that level with the investors, it could be broken. Why? There could be low investment confidence. The investors may lack confidence, or they may borrow the funds but not invest them. The investors could retain those funds and invest them later, so GDP will not have a significant effect in the short term or medium run, or if they may not invest it at all, or even if the rates are low, if investor confidence is low, they may not use them. So we have what is called a liquidity trap, in which there's a lot of liquidity and nothing is happening. So the interest rates are insensitive. The investment could be insensitive to interest rates. So we have what is called the interest-insensitive investment. Investment may not happen or may respond to the interest rates. It has happened before, but for the most part, low interest rates could stimulate investment. There are special occasions where that may happen, where investment doesn't occur even if the interest rates are low. So we can find ourselves in a liquidity trap. And when the level of demand for money, it stays the same even though if the interest rates have changed. And that could be a significant liquidity trap, where there's a lot of liquidity but nothing is going on. Let's take a look at that situation. When we're looking at interest-insensitive investment and the liquidity trap, nothing happening pretty much, even though the supply of money has increased. So the Keynesian transmission mechanism allows the link between the money market and the goods and services market to be broken in two, pretty much. So we have the money market and the investors right in between, and we have the supply of money. So if the investment is totally insensitive to interest rates, a change in the interest rate will not, and I repeat, will not change investments. Therefore, the aggregate demand and aggregate supply will not change. So here we have in the first model, the interest rate represented by the investment curve. Here we have if the investment curve is vertical. Here, in this case, if investment is vertical, the interest rates, it could be interest rate 1, higher rate, or interest rate 2, which is lower rate, the investment will be the same. The level of investment will be the same if it's interest rate insensitive. Instead of being downward sloping, it's vertical, meaning that it's fixed. It's fixed. So if we may find ourselves in a liquidity trap. If the money market is in the liquidity trap, an increase in the money supply here from MS1, supply 1, to supply 2, M2, supply of money 2, will not have any effect on the interest rate and will not have any effect on the investment. So here what we have, the demand for money will stay the same at that interest rate. So a significant effect of interest rate investment and liquidity trap is you can have too much, you can have an increase in the money supply, an increase in liquidity, M1 increases to M2. The interest rate doesn't change, stays the same, and the investors may not invest. So The model more specifically here indicates that when interest rate is insensitive to investment, it's vertical. The level of investment is the same regardless if we have high interest rates or low interest rates. And if the demand for money here, it's downward sloping and then it becomes horizontal at some point. Basically, it's stable, it's constant, and the money supply increases from S1, money supply M1, to money supply S2. It increases on this part of the model. The interest rate will stay the same. You can have a lot of funds, a lot of liquidity, but no change in the interest rate. If there's no change in the interest rate, there's not going to be a change in the investment, and there's not going to be a change in aggregate demand, and there's not going to be a change in the economy. So a liquidity trap is possible when interest rates don't change, even though the money supply has, and the economy doesn't experience any economic events. Now, here we have the Keynesian view of monetary policy broken down and explained. According to the Keynesian transmission mechanism, if the Federal Reserve increases reserves in the banking system, basically increasing the reserves in the banking system, the rates in the money supply and the interest rates will drop. Basically, if there's an increase in reserves or an increase in funds, stimulating investment and stimulating economic activity. Consequently, real GDP will increase. The way the Federal Reserve increases the money supply is not by increasing the money supply to the public, it increases the money supply through the banking system. So here we have number one. The Fed increases reserves by providing more funds in the banking system, therefore increasing the money supply. If it increases the money supply, the interest rates may drop. If they decrease, if the interest rates decline, investment could increase, and even consumption with lower rates, and so on. Here we're talking only about investment primarily. If investment increases, therefore an increase in aggregate demand occurs and real GDP. So this is the transmission mechanism step by step, how it occurs, and then the economy is stimulated later. So this takes some time typically. If the increase in the money supply does not influence investment because of the liquidity trap, having too much funds with no change in the interest rates, and there is no significant effect, there's no change in economic activity. And there's not going to be a change in investment, and there's not going to be a change in aggregate demand or economic activity at all. So it can go in both ways. Most of the time we expect that an increase in the money supply can stimulate the economy, but it's possible for an increase in the money supply to not have a significant effect if there is the issue of liquidity trap or interest-insensitive conditions. If we look at the Keynesian mechanism getting blocked, it can be ineffective, and that ineffectiveness just creates a lot of funds and potentially could affect the price level with a lot of liquidity. So therefore, we need to be careful. In the market, we see that bond prices, government bonds, and interest rates are inversely related. Government bonds, essentially, when government issues bonds, they are bought and sold in the market, and they pay an interest, and that interest is inversely related to the bond price. At low interest rates, with low interest rates, and the money supply increases, but the bond prices may be different. So when we're looking at low interest rates, the money supply increases, but does not result in significant excess in the money supply because it could be used in the bond market. When interest rates are very low, the bond prices tend to be relatively high. And, this is often confusing for people. Why, with higher bond prices, why is the interest rate low? Shouldn't a high bond yield a higher interest rate? They happen to be inversely related. The buyers could believe the bond prices are so high that they have no other place but to go down and so on. So the individuals will rather hold the additional money supply than to buy bonds. And when we're looking at the bonds and interest rates, the higher the price of the bond, the lower the interest rate. With the interest rate being high, the lower the price of the bond. The buyer could choose to buy bonds or hold the funds when the price of the bond declines. It really depends on the market. The bond market could be very simple or could be a little bit complex, but for the most part, bond prices tend to be tend to have a stable price that can increase or decrease depending on the state of the economy and the money supply as well. So we have a different approach to money supply and monetary policy. This is referred to as the monetarists. The monetarists are a little bit different than Keynesian, but still have the similar approach. But they're different. The monetarists are different than Keynesian, but are a little bit more direct. The monetarist theory proposes a direct link between the money market, the money supply, and the goods and services market, directly on the aggregate demand, aggregate supply. The monetarists believe that an increase in the money supply, or when the money supply changes, is going to have a direct impact on the aggregate demand right away. Nothing in between, just right away. So an increase in the money supply, in the money market is going to directly increase aggregate demand. Directly. And when aggregate demand increases, the gross domestic output increases, and also the price level. This is important. This is one of the main distinctions. The price level is going to increase. And if the money supply decreases in the monetarist perspective, the monetarists believe that aggregate demand is going to decline right away. And the gross domestic output is going to decline, and also the price level is going to decline. We can actually contradict and see that the price level doesn't really always decline. It stays the same, or if anything, it increases. But the monetarists have a different perspective than Keynesian view, the Keynesian view of monetary policy. Here we have the transmission mechanism through the monetarist perspective with an increase in the money supply. The monetarist transmission mechanism is very direct. It's short and direct. If we have a change in the money supply from S1, money supply 1, to money supply 2, we have an increase in the money supply from M1 to M2. If the interest rate remains the same here, they're assuming the interest rate remains the same in the short term, we're going to have an excess supply of money, and that excess supply of money can stimulate consumption, investment, and so on, and have a direct effect in the market. The aggregate demand is going to shift from AD1 to AD2. Aggregate demand increases right away. And the quantity of output, gross domestic output, increases from Q1 to Q2. And if you notice, the price level increases from P1 to P2, equilibrium 1 to equilibrium 2. We have a direct link. Now, it is possible for prices to increase. The question is, how quickly are they going to increase? This is a direct effect in the market. The money supply increases. It's going to increase aggregate demand from AD1 to AD2. Output increases from Q1 to Q2. The price level goes from equilibrium 1 to equilibrium 2 at a higher rate in the goods and services market. What we notice is that often it does take time for prices to increase, and eventually they do rise, which means that an increase in the money supply can increase prices, and consistent increases in prices could lead to inflation. It's possible over time. How quickly? It depends. So we can have two different monetary approaches. An expansionary monetary policy, by which which means that the Federal Reserve increases the money supply, and if we go through the monetary perspective or the Keynesian perspective, it can increase aggregate demand, whether it's direct or indirect. A contractionary monetary policy consists of the Federal Reserve decreasing the money supply, contracting the money supply, and therefore it contracts the economy through lower investment, through lower aggregate demand, lower output if it's indirect, or if it's direct, aggregate demand and GDP will decline. Contractionary monetary policy. Now, most economists and most Keynesians believe that the natural forces of the market in the market economy work much faster and surely in eliminating any inflation gaps and eliminating recessionary gaps. When we're looking at sometimes when the market can find itself in trouble. However, the natural forces sometimes need some stimulus from the banking system, the Federal Reserve, or the government itself, because it could take a long time. John Maynard Keynes did explain it himself that in the long run, if the natural forces take a long time to occur, the economy can stay in a crisis, in a recession, for a long period of time. So it's important to note that the natural forces could resolve economic activity, but some stimulus is needed, depending whether we're facing an inflation or a recessionary gap. So here we have monetary policy and a recession. So if the economy in Model A, we have the price level and the level of GDP, gross domestic output, the level of output produced in a given economy for a particular year, is represented by the aggregate demand curve, AD1, and the aggregate supply, AS1, in equilibrium at Q1. Q1.1, equilibrium 1, the long-run economic activity or the natural level of GDP is greater than the current output. The output is below potential or below natural levels, and the economy is in a recession. The recession gap is measured by the distance between the level of output, the current output, versus the natural conditions of the market. With the economy self-regulating and the natural forces stimulating itself, we have Model B. The economy will naturally, this is important, if the economy eventually heals itself naturally through the natural market forces, the aggregate supply curve will shift to the right from equilibrium 1 to equilibrium 2. This is when the wages adjust, prices are adjust, the economy adjusts naturally on its own. If it adjusts naturally, the level of output will go to the natural levels and the economy heals itself through natural market forces. Model C indicates with an appropriate increase and deliberate increase in the money supply or an expansionary monetary policy, we can have a recession in Model A, but we have to go straight to Model C. With an increase in the money supply and the transmission mechanisms, we can increase aggregate demand from the Q1, which is below natural levels on the aggregate supply curve, increase aggregate demand by stimulating investment, consumption in the market, whether it's indirect or direct by the monetarist perspective, and the aggregate demand curve will shift to the right, closing the recession and going back to the natural levels. But notice what happens to the price level. Here the price level drops if it's flexible downward. In the second model, the price level reaches a new equilibrium and may potentially increase. So that's the side effect of a money supply increase. It could generate higher prices in the market. If this price level is increasing steadily and stable, may be okay, but if it's increasing too much to close the recession, that could have some negative effects of inflation pressure later on. So here we have the increase in the money supply through direct economic monetary policy, and Model B indicates just let the market fulfill itself, it will naturally heal itself, and it could happen. The question is how long? And what we see is that prices are not always flexible downward, wages are not flexible downward, and this could actually not occur eventually. It could take a long time for Model B to occur. It's more likely to have Model C. Now, if we have an inflation, this secondary model indicates an inflation and monetary policy. The aggregate demand AD curve, aggregate supply AS curve, the long run aggregate supply, the green curve vertical, the natural level of GDP is below the current level of gross domestic output at equilibrium 1. Notice how output is greater than the natural conditions of the market. Currently, the market is in an inflation period here. Model C indicates if you leave the economy by itself, it would eventually close this gap, this disproportion, this equilibrium, and it will shift the aggregate supply curve to the right and close the inflation gap and go back to its natural levels of production here, natural levels. It will close the inflation gap. But this is a little bit contradicting because if we are in equilibrium 1, if we close this inflation gap and the aggregate supply curve does shift, you may end up with a little bit more inflation or with regular prices, but at a higher point, and natural level of GDP goes back to normal in this case. So this one I have a little bit more of a doubt whether or not it could work, but it could happen. if the economy eventually heals itself, assuming we had no monetary policy, assuming we have no fiscal policy, the economy could go back eventually on its own to natural levels of equilibrium where the AS curve intersects the aggregate supply at S2 and aggregate demand at AD1 to close this gap. Model C indicates that with an appropriate decline or with an appropriate decrease or contractionary monetary policy, when you contract the monetary policy, the money supply in the economy, if you decrease the money supply, it goes through the transmission channels, direct or indirect, aggregate demand will decline. Here, AD1 shifts down to from 0.1. Notice how Q1 is not in equilibrium with Qn. It would, with a decrease in the money supply, we're going to get rid of the slight inflation by eliminating the inflationary gap and decreasing the aggregate demand. By decreasing aggregate demand, go back to equilibrium 2. And we're now in long run equilibrium, in the short run equilibrium, and with aggregate demand at equilibrium. And this one could actually eliminate an inflation gap and also lower the prices, deflate prices with a decrease in the money supply, Model C. So it's important to know the economy could heal itself, but the time that it takes for it to heal, and naturally, could take a long time. So we could have policy making that could resolve the matters in a little bit more reasonable time. Now, there's different views of monetary policy. The monetarist, the Keynesian approach, when it could work, when it could not work, when leave it alone, could it go back on its own to the economy level? Sometimes we use a little bit of both, depending on the state of the market. And we have a different view, which is proposed by Arnold King, and his view was the pattern of sustainable specialization in trade. And basically, what Arnold King proposed is it's a very different approach than the monetarist and Keynesian. Keynesian was a little bit of a monetarist, but the extreme monetarists believed that there was a direct link. Keynesian was like, no, we have to go through the investors, to the consumers, the government, and so on in the exchange rate market. Here, Arnold King expresses a different way of the money supply and the economy. Arnold King specifies that the decline in economic activity may have nothing to do with a decline in aggregate demand, or vice versa. An increase in aggregate demand may not have anything to do with an increase in the money supply, etc. So if we more specifically, he focused on a decline in economic activity. And he stated that a decline in economic activity can occur even if aggregate demand stays the same. So basically, you could have a decline in economic activity even if aggregate demand remains the same. And there have been some events in which aggregate demand was fine and something happened and economic activity declined. So you can actually kind of say the COVID-19 here, it generated a decline in economic activity. It was not demand induced. Actually, people rushed to the stores to buy stuff. Investment was fine, and something happened, and aggregate demand was good, was constant. Everybody, the economy was well. But when we have this crisis, so we have here that Klein stated here. So it's possible, but it's rare, that a decline in economic activity may have nothing to do with a decline in aggregate demand. It could be something else that could create aggregate demand here. But he specified basically on patterns of sustainable specialization in trade. That was his main view. Nothing to do with what's going on today. But it could be related. According to Kling, economic activity is best viewed as focusing on specialization, the level of production of goods and services, and trade. The number of sales may decline not because aggregate demand has dropped or consumption has dropped or consumers are not buying or investors are not selling, but because business and labor are out of synchrony with what buyers want to buy. Essentially, if buyers don't want to buy the product anymore, it naturally stops selling. So the current pattern of specialization in trade could be unsustainable. Basically, the market adjusts on its own and it creates demand for products and consumers stop demanding other products. And with those products that stop being demanded, nobody buys them anymore because there's not consumer interest and it could decline. Now, it is the job of the entrepreneur, according to Arnold Klein, to figure out what's happening to re-specialize and to begin engaging in economic trades that are sustainable for both the buyers and the sellers so that the market needs are always met. In some signs, fiscal policy and monetary policy stimuluses designed to boost aggregate demand may not work to revive the economy. That was the view of Klein. Because if consumers are not demanding the product and they don't care about the product that's been produced, even if there's an increase in monetary or fiscal stimulus, they're not going to buy it. So he basically said there was a misproportion between buyers and sellers and what consumers want. Essentially, consumers determine economic activity on the view of Klein. Other people, like the activist and non-activist view of monetary policy or other beliefs, view monetary policy different. These are people or individuals that argue, the activists, for example, argue that monetary and fiscal policies should be deliberately used only to smooth out business cycle activities. When we have business cycle crisis or big business cycles, increase in economic activity. The activists are actively use monetary policy when needed to stimulate the economy, to slow down the economy, or to help the economy. The non-activists have a different view of the economy. These are people that argue against the deliberate use of discretionary fiscal and monetary policies to smooth out the business activity. They believe that in this case we have a permanent, stable, oriented monetary policy and economic fiscal framework. So basically it has to be stable and consistent and not used like the activists during active need. The non-activists are basically use monetary policy to stimulate the economy and gear the economy through some stable platforms or consistently use it. The activists just use it when needed through some economic business cycle concerns. There's different views between the activists and the non-activists. When to use monetary policy is literally up to the discretion of the Federal Reserve and the state of the economy. And sometimes it's used even if the economy is doing well. So a little bit of non-activist. Sometimes it's both non-activists and the activists because people that make decisions have these two views. So sometimes it's used when it's needed, and sometimes it's just in a non-activist perspective. Use it to smooth out the ongoing economic conditions. So the case for the activists, or the use of discretionary monetary policy in this case, in the view of the activists. The case of the activists, in this case, they argue three main points. The economy does not always equilibrate or quickly enough to natural levels of GDP. Basically, the monetary policy can be used, but it doesn't always lead to quickly establishing natural levels of GDP, or the economy will not always on its own reach natural levels of GDP. So we need to consistently use monetary policy in order to reach that target. The activist monetary policy works and is effective at smoothing out business crisis if it's used actively in the market. And the activists believe that monetary policy is flexible. Monetary policy is flexible. You can increase or decrease and reach a target when needed. The non-activists view it as not always flexible. They see it differently. So it's basically rule-based. You have to be consistent because monetary policy could have irreversible effects to some view on the non-activists. So we need to be careful with when to use monetary policy and how to use monetary policy because it could have economic effects. The non-activists claimed three major observations. In modern economies, according to the non-activists, wages and prices are sufficiently flexible to allow the economy to equilibrate at reasonable speed in terms of the national real GDP. This is where I slightly disagree with the non-activists. Wages are flexible upward, and prices are sticky and flexible upward. So for the most part, very few people are going to get a wage cut. You could provide lower hours of employment, cut the hours to half, and that's some flexibility there. But the actual wage stays up. The actual figure wage. If you average out the number of hours, you could cut the number of hours, cut the wage in average levels, but the wage is typically set. and you have labor unions and so on. Prices are fixed, are sticky. They're inflexible in the short term, and then they can increase. And wages, if anything, wages are argued to be increased. But you could lower the average wage or the average earnings by cutting hours of people from working full time to part time. So that could work that way. The activist monetary policy, it's argued from the case of the non-activists, it may not work. If we have flexible wages and flexible prices. So they contradict the monetarist perspective or the activist perspective. So here the non-activists look at monetary policies are likely to be destabilizing rather than stabilize or improve the economy. They're likely to make matters worse in some cases, not better. And you could argue that point number 3 is relatively, it makes sense. Sometimes an increase in the money supply could create liquidity traps, a lot of funds, and those funds sometimes are held by certain individual groups and not make it to the market. And then there have been cases, and monetary policy could lead to potential inflation and increase in prices in the long run, and have no change in the level of GDP. They could not influence GDP. If anything, the non-activists argue that too many increases in money supply can lead to a higher increase in the price level or inflation over time, and eventually in the long run the level of gross domestic product goes back to its normal levels. It stays the same. It can increase it in the short term, but in the long run it goes back to its normal level. So point number 3 is actually a very good one, because we have experienced higher prices over time, which is inflation. If you compare the prices between 2000 to 2020, prices are higher. The level of economic activity is increasing at a normal rate, and you can destabilize the market. But for the most part, I think that some good, stable monetary policy is needed. So point number 3 is good. Now, when we're looking at monetary policy uses, you could use monetary policy regardless in the market. Every country does. And monetary policy could be used to fine-tune the economy. And it's the frequent use of monetary and fiscal policy, or a combination of both, to improve economic activity, to accelerate, to stabilize the economy, to counteract small undesirable events in economic activity. And essentially, it does help improve economic activity in the short term. In the long term, we could have higher prices if it's not contracted or deflated, and GDP could stay the same and go back to normal levels. We could use monetary policy to have an inflation target, meaning inflation targeting is the level of prices and how much they should increase over time. 1 to 2% inflation targeting. Every year inflation could increase by 1 to 2% in order to maintain stability in price or consistent prices, or consistent growth in prices, or have a nominal GDP targeting, depending on when it's used or how it's used. So monetary policy could be effective depending on how it's used, and responsible use of discretionary monetary policy is important because it could have direct or indirect effects in the market depending on how it's viewed. Thank you, everybody, and have a good day. We'll continue next.